back to the Strategic Investment Conference. As much as I personally enjoy interviewing our next guest, I am going to step back and humbly yield the interview chair to the GOAT of financial interviews, Grant Williams, who, of course, is the author of Things That Make You Go, And he is joined by Felix Zulauf, always one of the most popular speakers at the Strategic Investment Conference. You all know Felix. He's the man who needs no introduction, former global strategist at UBS, founder of Zulauf Asset Management, now runs Zulauf Consulting. Gentlemen, this is a much anticipated conversation. I really look forward to it. Thank you both for being with us again this year.
Thank you for having us.
And thanks, Felix. Good to see you, my friend. It's been a long time, and there's a lot going on in the world. And what I'd love to do, if I can, just to kick things off, there's so much to talk about, but whatever you've been kind enough to come on and join me on my podcast, I always give you the floor at the beginning to give a big macro overview of how you see things. And I get so many emails from people just thanking me for giving you that time to really lay things out, how you see the big picture. So I'd love to start doing that and with this conversation. And I know there'll be plenty of questions that come up from that. So the floor is yours. Give us a sense of the big picture as Felix Zulauf sees it right now.
Okay, thank you very much. Well, normally geopolitics and geopolitical events is really not important to financial markets because you have short-term events and you get a short-term distortion in the trend, and then the market goes back to where it was. I think we live in a time where it's different, where geopolitical events and developments matters. And about 5 years ago, a little bit over 5 years ago, in fact, I started to write for my subscribers that we are moving toward war, military conflicts, tremendous rivalry that will intensify, et cetera, et cetera. And what we have seen is that the regional conflicts that we see in Ukraine and in the Middle East, they are not just regional conflicts. They are now, with the geopolitical power struggle, the rivalry between the US and China, they have been elevated to the global level. And therefore, it has a different quality in terms of conflict. And we could discuss who is provoking whom, etc. That doesn't lead us very far. The fact is that we are trapped in this two-sided trap. We had the US-centric unipolar world order, where the US dominated the world because the Communist part had no saying in terms of economic affairs. They were an insignificant factor economically and only a military factor. And then when the wall came down, the communist world changed and integrated into the world economy. And the US remained the empire, the hegemon, so to speak. And with the rise of China, obviously, China wants to change the world order because it thinks it's unfair, it favors the US, and it wants to have more saying, and it is pushing for a multipolar world order, and the US is trying to defend it. And that's the overriding problem out there. And I think the rivalry and the conflicts will intensify. As Peter Malmgren said, I think also that we are already in World War III, and most people do not recognize it. But remember, in 1939 and 40 and even 41, most people did not recognize that we were in World War II. So we are in a war environment, and the war environment will intensify as I see it, because we are completely lacking diplomacy on the side of the Western side. Biden has not talked to Putin for over 2 years, which even during the Cuban Missile Crisis, the US president and the Russian president, they kept talking to each other all the time. And I think this is the problem, because eventually the unipolar world order cannot be held on to. It is crumbling, and it has probably already gone. And the US is trying to defend it. And we go to a multipolar world order eventually. The problem is, how do we get there? There are two ways, either via diplomacy or via war. And the way I see it, the odds are much higher that we get there through war and the bigger conflicts overall. Like Peter Mauldin said, the war will not be that Chinese tanks will ride down Pennsylvania Avenue or so, but there will be cyber attacks, there will be sanctions, there will be protectionism, there will be missile attacks, etc., etc. And it will change the economic framework for businesses. All of a sudden, investors in Russian assets that they thought were cheap got much cheaper, worthless overnight. And it could happen with Chinese assets, the same thing. And this is a different world, and therefore you cannot approach it the way you approached it in the past. Now, this is all mixed up and blended with the long cycle in economics and in finance. And we have had 40 years of disinflation, declining inflation rates, declining interest rates. And it was fantastic because you had rising valuation and a booming financial asset market. And everybody, all the asset-rich people were doing very well. This game is over too because of the sort of partial disintegration that is beginning in the world economy, that you see that the world economy will become less efficient and therefore less productive, and therefore goods and services will become more expensive. And that means that we are now in an environment of secular rising inflation, not cyclical, but secular rising inflation and secular rising interest rates. And this is a different ballgame. And what we have seen so far is the first upcycle in inflation and the down cycle in inflation. And that down cycle may run a little bit further. And it is even conceivable that we have some sort of a recession beginning sometimes this year into next year. I'm not sure about that. I see some of the factors that you usually see before a recession, but there are other factors like the fiscal deficit, because I do not believe that the fiscal deficit will stay where it is. I understand if the deficit is smaller this year than last year, that it's a negative for growth, but I'm not sure the deficit will stay small because we are in a war and deficits continue to grow and go up. We just had Congress deciding on almost 100 billion new money that is being spent. And believe me, that money is not to help Ukraine in the future. This is to pay old bills, because do not believe that the US military complex did not send weapons and ammunition to Ukraine over the last 6 months. They did, but it was not paid for. And therefore, the Republicans have agreed because there was an open bill and they had to pay for that. And that will continue in the world I see. And therefore, the deficit will not come down, will probably grow even bigger. And whoever gets elected, they will follow in the next legislature. They will follow a populist economic policy. That means rising deficits, rising fiscal spending, basically underwriting the economy that has some chronic problems that Lacey Hunt outlined so well in his speech. And therefore, we go into an expansive fiscal policy that the central bank has no other choice but to accommodate. The national savings rate is negative right now. That means you cannot finance all the deficits that you have. You rely on either foreign capital or you have to print the money. And I think there is a very high chance that you will print the money. And actually in Europe, it's very similar. The Western world is in a similar situation. So that is the long-term framework. And that means that asset prices, you have to value in a different angle. I think bonds are completely out as a long-term investments because eventually the bond market will melt. It's obvious that some governments will go bust over coming years, and I think it will start with Europe, not with the US. The US government has a lot of assets it could sell, like land, and if it sells the land, it could fix the balance sheet of the government. That's not true for many of the European countries that will probably go bust over the next few years. So we are dealing with governments that could default. We are dealing with a meltdown of the bond market. We are dealing with probably a coming currency crisis of major proportion. Most people do not understand that the US dollar has lost 87% versus gold in the last 20 years, since 2002. 87%. It has lost 98.5% versus gold in the last 50 years. And it has lost about 98% in the last 100 years in terms of purchasing power. And this trend is going to accelerate. So we are in for the crisis and chaos Neil Howie explained so well. And it's a cycle. Eventually, the cycle will turn. And I think the cycle will turn sometimes early next decade. But until then, we will go through this cleansing process that includes crisis. Now, where do we stand in this cleansing process? I said this decade or the next 10 years will be the decade of roller coasters in the financial markets. And we are in that roller coaster. We called for the top in late 21 and the decline. I called the bottom in 22, but I thought we would have a recovery attempt that will then lead to a second decline. And the recovery attempt I expected into the low 4,000. And then I turned bearish again, which was a mistake. So I missed the move from April to July, which was 4,200 to 4,600 in the S&P. And then I called that top for a correction. And in November, I said, we will have a rally into late first quarter that will probably conclude this bull market. There are two options here. If the central bank continues to pursue a monetary policy that is on the easy side, with all the maneuvers that we have seen from the Treasury Department that injected liquidity into the financial system, and that really created the rally, then we could go to higher highs eventually late this year or early next year. That's a potential alternative to my preferred outcome. That is, a medium-term top has been in place. The first medium-term decline has started. The first short-term decline ended a few days ago, and we are bouncing into May. And sometimes in May, probably towards the middle of May, we will try to turn down again. And if the bearish scenario unfolds, we will turn down at the lower level than where we peaked. And then we go down. And if the economy turns more recessive than many believe right now, and earnings become a problem, then of course we are talking a big decline. And not because of the economy, it's because for technical reasons. You have a tremendous concentration in a few stocks like never before. Remember the Nifty 50s were 50 stocks, and that was a tremendous concentration. And then they declined sharply. Even so, many of those corporations had rising earnings, but they declined between 50 and 90% because of the excessive valuation. Now it's 10 or 7 stocks. At some point, 10 stocks amounted to more than 50% of the NASDAQ 100. So you have a tremendous concentration. And on the way up, everybody who wanted to perform in line with the market had to own those stocks. And if you wanted to outperform, you had to own more than they are weighting, which means there is now a large concentration in a few stocks that is a problem for the market when the momentum turns down. And when some selling begins, because the only stuff they can sell in a big quantity are those same stocks. And that means those same stocks that are highly valued have a lot of room on the downside until they are fairly valued. And usually in such a sharp decline, you undershoot. So it's quite feasible that we have a big decline that has started, and that could last into late this year or early next year, and that could easily be down 30% or so in the stock market. That's the bad thing. The good thing is that if that happens, then the authorities would come in. You had a new administration in place from early next year on, and they would expand the fiscal policy to underwrite the economy if there were a problem. And they would, of course, accommodate and stimulate on the monetary side. And you would have another run-up. And the run-up would probably go to 6,000, 7,000 on the S&P, new highs. And that is what I'm really expecting. And that new highs could then top out sometimes, let's say, in 26 or so. And then at that point of time, if that happened, it's very clear we would be in the second wave of rising inflation with all the stimulation that would go on, and that would lift commodity prices quite dramatically, of course, and that would lift inflation, and that would lift interest rates and bond yields. And if the Fed would lean against it and try to go for yield curve control, it would just crash the dollar because that weakens the currency when you do it, just as the Japanese. They can tell you what happens when you do that. And then we had at some point a situation where higher interest rates were just too much for the stock market, and then you had another decline. So that's the roller coaster I see. And then, of course, you have all the fiscal crisis that we are entering, and the war going on, etc. So a real mess. And that messy situation will probably end sometimes late this decade or early next decade, and then the system gets cleansed. We may have a few new currencies, and the question is what to do about it. First of all, I think if you can time the cycle, or you try to time the cycle, you should do it, because the roller coaster can give you tremendous returns on both sides of the market. If you cannot time the cycle, then I would recommend for somebody who cannot time the cycle, I would recommend to go 1/3 into gold and 1/3 into index type of stocks, or ETFs heavily weighted towards commodities. And that would be a mix with 2/3 equities, heavily weighted to the back-end side, to value stocks, because I think we are at the crossroad where growth begins to underperform and value begins to outperform. And that means that financial assets begin to underperform real assets. So commodities will become more important. It also means that the US market may begin to underperform foreign markets, emerging markets in particular. They are more geared to the back end of the cycle. So this is a big change I see coming on. Wild times, interesting times, very challenging, and do not stay on the wrong side of the market.
Beautifully done, Felix. This is every time I get to listen to this, it's amazing how many notes you take. But I think the most important takeaway for people, and certainly for me when I listen to you talking about this stuff, is that the idea of just buy and hold is a much more dangerous one now. And the way you've laid out these cycles and the way you've called them over the last 2 or 3 years and called intermittent peaks and troughs and seen the market swing around is an object lesson for anybody that thinks this is easy. And it has kind of appeared easy for many, many years now. The world you've just described is a much, much trickier one to navigate. So I want to dig into a couple of these things that you've talked about. There's so many points we could pick apart, but I want to start with something, a phrase that a lot of people will be familiar with, and one that you used in a recent note to your subscribers, and you've used fairly frequently. That's crack up boom, and that phrase has become kind of something that people vaguely kind of know what it means, but there is a very specific definition of this going back to the Austrian School of Economics. So perhaps you could define a crack up boom for us and tell us what you think that looks like potentially in the world that you've just described.
Well, a crack up boom is really a part of an economic crisis. It is when the authorities manage the system, so to speak, and they pursue an inflationary policy. You have a boom in nominal terms, but you really have a recession in real terms. And just as a side note, Larry Summers recently said he redid the whole inflation computation based on the procedure that was done in the 1970s. And he has come to the conclusion that actually the US inflation peaked last year, not at 9%, but at 18%. And inflation is now 7% and not 3%. If that is true, then you have a recession already, but you do not recognize it. Of course, corporate earnings are nominal. They are not real. And for corporate earnings, they continue to grow, and nominal GDP continues to grow, but in real terms, there is no progress. And that shows up in some kind of rising dissatisfaction by an increasing number of people because they realize they are falling behind. They cannot keep up, and their standard of living is going down, and their prosperity or wealth factor is going down. And the crack up boom is really that you have a nominal boom, but in real terms, for the average Joe, it is a negative experience. And you have in a crack up boom, you have rising commodity prices, you have rising interest rates, rising inflation rates, and you have rising stock prices. Argentina is such an example. You have a straight line up in the stock market, but that's not the sign of current and future prosperity. That's a sign of misery. And I think that could develop, particularly if the authorities continue to underwrite the system by expansive fiscal policy and then use accommodative monetary policy to pay for it because there is no other way left. Then you have a crack up boom. And I think there is a risk that we could see that.
Yeah, it's amazing because a lot of people will tell you they firmly believe we're in the middle of the crack-up boom now. And you made the point, which I thought was really interesting, that these crack-up booms look like the Goldilocks scenario, which so many people kind of cling on to. So just describe that. Describe what they look like, how they can mislead people into thinking there's something different, and also the way that people need to think about this in their heads, because it suddenly doesn't all become about stock prices just going up. There has to be a real component to it, and that's a very different mindset.
Well, obviously, the economy is doing well in nominal terms. You have retail sales going up. You have housing prices going up. You have less sales in housing, but you have prices going up, particularly in the booming areas, in the wealthier areas. And people believe, well, there is no crisis in that sense. Things get more expensive, but there is no crisis in the sense of a crack in the system, a decline in the economy like a normal recession. It's a different feeling. The feeling is not as bad because people do not understand that they, with their personal situation, are actually in a recession. because they are losing out. But they see rising prices, they see rising retail sales, they see rising earnings from the corporate sector. And in earnings, you have to differentiate. 43% of the Russell 2000 companies reported negative earnings. So it's the big guys that are in good financial shape that are doing well and can report growing earnings. But the smaller guys and the medium-sized corporations that are heavily indebted, etc., and have not a clean balance sheet, they are not doing well. They are suffering badly. And the very small shop owners, they are doing very badly. I talked to some of them, and they are not doing well. So it's a very strange environment that is very different from a normal recession that we know from our experience, or from a normal economic boom when everybody feels well.
You want to make sure we kind of cover as many topics as we can. You talked about the bond market, and kind of almost like a throwaway line, you talked about the bond market being something you absolutely have to avoid and it's going to melt down. How should people think about that? Should they stay at the short end? Should they move from the sovereigns to corporates? How should people think about being in the bond market? Or is it really a five-alarm fire and don't be in the bond market whatsoever?
I remember the days in the late 70s, early 80s, when I did research for the coming secular turn in bond yields. And I wrote the piece, The Buy of a Generation for Bonds in 1981. At that time, bonds were called certificates of confiscation. And I think at that time it was not appropriate, but I think this time it's correct, because several governments will default, and financial repression will increase and intensify. And that means that institutions may probably forced to own and buy more treasury bonds or government bonds than they have to right now. And things like that. It's like in a war. It's like in a war during war times. The war loan in Great Britain came out to finance the war, and even in Switzerland they are talking that we should have a war loan, confederation war loan issued to finance the increase in defense spending and things like that. So. You have to understand that with rising inflation, which is also a result of geopolitical conflicts and war, of course, and economic mismanagement, both together, that you have rising inflation rates and rising bond yields. And of course, when you have rising bond yields, at some point of time, that creates an economic problem. And when it creates an economic problem, the government is at risk, and the politicians are at risk of not being re-elected. So they come up with new gimmicks. They could increase taxes, which is not very popular with the constituencies. So they try other gimmicks, and money printing is the cheapest way, because it doesn't hurt in the short term. It's even positive in the short term. It makes stocks go up and house prices go up and things like that. So that's the environment we are in. And, the bond market, you can trade it, of course, as a trader, but I would not invest. I think actually the bond yields are approaching a reversal point, medium term. And with the a slowdown in the economy that I expect going forward for the rest of this year, I think bond yields have a potential to decline. Maybe 10-year Treasury down to 3% or so. You have to keep in mind that the bond market is a managed entity. It's not a free market anymore. Last October, when bond yields went to 5%, I think the political authorities panicked. They were afraid of getting into another trust moment, like in the UK when that government for a short time came up with an expensive fiscal project, and bond yield shot up 150 basis points. So I think they intervened. Last October they intervened, and that intervention was really what started the stock market rally eventually. And it brought interest rates down. And then interest rates went back up again because there is still a problem, and the supply problem also in the bond market. And of course, you can come down with declining inflation and with a slowdown in the economy. Then you get a decline medium term. But I think eventually there is no way out. The authorities have to take over, and they have to underwrite this system. This is so different from the 1930s. You know, we have sort of a depression-like environment, but this depression is very different. It's an inflationary depression, whereas in the 30s it was a deflationary depression. At that time you had an anchored currency, anchored to gold, and they let the economy go down. This time you have a fiat currency system, and they underwrite the economy and they let the currency go down. And the consequence is, unlike the 1930s, where bonds were the place to be, you know, this time that is definitely not the place to be. You have to move away. As a long-term investor, I would not own bonds, and I would recommend to use the next decline in bond yields into later this year, into the second half, to sell out of bonds and go short money market or into gold. As I said, the best asset you can have is probably gold. Gold outperformed even the stock market over the last 20 years. You wouldn't believe that, but it's true.
Yeah, no, I absolutely would believe that. What about tips? Do tips have a place in this landscape?
It's government type of paper, and you cannot trust any government at this point of time in the cycle.
Right.
Stay away from everything. Stay away from everything that has the stamp of the government on it, because you cannot trust it. You have to move to private assets. You can analyze, you can trust, where responsible people are managing the situation. That's the way to go.
Yeah, and that is, as we've talked about, that's a wholesale change. People looking at private assets, everything's become about things that are quoted 24 hours a day, that they can watch the ticker and watch the numbers go up. Listen, I'm going to switch to some of these questions, because we've got lots coming in, as I knew there would be, just to make sure we get some in. So let me just ask you a couple of these. First one, for 2024, have we hit the high already? Do you still expect an important low this year? And if so, around what sort of time frame?
I think we have hit the high in most of the indices. In the US, I would give the European indices the chance that they could go to a minor new high, but not only minor, not major. And then I think we go down, and the downside risk is really around 3,000 in the S&P, and very late in the year. If that scenario unfolds and we have some sort of recessionary extreme slowdown, earnings problems, and then we have a liquidation wave in the stock market, and particularly the liquidation wave among the Magnificent Seven or the Magnificent 10 or whatever you call them. And that is why growth will underperform value. And value will also go down, but it will go down less. And usually when you then go to the bottom of the mini cycle, so to speak, late this year or early next year, then the ones that have outperformed during the down cycle are the ones that are the new leaders for the next up cycle. And I think that will be very likely commodity related with some of the other value stocks, but heavily value material, commodity materials oriented. That's to go. I could easily see the price of oil in the war scenario and everything going to $250 or so, sometimes in 26, 27.
Right. There's a couple of big dichotomies here, and there's a couple of questions, and I think I can probably wrap them in together. We have these dual narratives of an inflationary environment and a deflationary impulse should we get the recession. And you mentioned Lacey Hunt earlier on, who has a very strong view about the deflationary nature of the government debt. We have, as a backdrop to that, this enormously strong inflationary pulse. And one of the questions here also is, how do you reconcile a commodity boom against the inflationary impact the governments are desperately trying to kind of cram down? How do you play the fact that there are strong inflationary impulses and strong deflationary impulses at the same time? How do you kind of juxtapose those and try and deal with the two at the same time?
Well, we are in a transition period from disinflation to inflation. And in a transition period, you see different and counter type of signals that do not match. That's normal in a reversal pattern or in a transition period. You see both sides, so to speak. One is early for the next cycle, and one is late from the old cycle. So you see all those signals. I see, of course, the monetary situation. The monetary situation has been very strange in this current cycle, and I had some trouble dealing with it too. We have seen a big rise in reverse repos on the Fed's balance sheet, and that was due to the banks not hiking their interest rates for deposits as much as they should have. So you had an outflow of the banks, which restrained lending activity, and it went into repos because there were not enough treasury bills for the money market mutual funds, where the money ended up from the banks, to buy. So the money market mutual funds must buy a certain amount of treasury bills, most of them treasury bills. And there were only about 3.2 trillion treasury bills available. And the money market mutual funds were going to 5 trillion and then 6 trillion, etc. So they could not buy the stuff they needed. And as a result, they have turned to the Fed and that, why don't you create artificial treasury bills in terms of reverse repos? And that's what made reverse repos going from almost zero to 2.8 trillion or something like that. It's now coming down, and it's now only about 400 billion or something like that, because Yellen then said, we have to stop the bond market riot at 5%. And they had to inject liquidity into the system. But the Fed was still saying, we are on tight policy, we have to break inflation, bring it down to 2%, we are tapering, etc., etc. So Yellen said, okay, then we unlock all the sterilized money in reverse repos by issuing primarily treasury bills at the very short end and no bonds, and then the money market funds can buy them and sell their repos. And as they sell their repos and buy treasury bills, the sterilized money at the Fed's balance sheet was injected into the credit system, and that was part of the whole rally that was behind it. And I think a lot of monetary analysts had trouble to deal with this because it has distorted many signals that we usually get. In my view, what it has done is it has extended the business cycle or the recovery from 2020, but it doesn't mean that there is no downturn to it. And if there is a downturn to it, it should be about now. We have a system that is called the MEL rule, that is basically the unemployment rate by state, by individual states. And when it goes 0.25% above the 18-month moving average, then it gives a recession signal, and it has been a very reliable signal, and that signal arrived just about a few weeks ago. So be aware that the risks are out there, and it fits together with my technical work in the stock market, where I think the market is at a much higher risk of a bigger decline than most people think of.
Okay, great. We've talked about the various different cycles. We've talked about this idea of a crack up and what that means. What do you think are going to be the types of bubbles that we will see going forward, ones that perhaps better serve policy and fiscal interests? How different are they going to be from the current set of bubbles that we've been navigating?
Well, I think the next big bubble that we will get eventually later this decade is a bubble in gold and silver and platinum and palladium and copper and nickel and lead and all that kind of stuff. Keep in mind that the BRICS and in that conflict between the BRICS and the G7, the two camps, the BRICS control 75% more or less of the natural resources of this world. And obviously, as the conflict intensifies, they will make supply less available, no question, which is good for their income and bad for the contender on the other side. So I think investors will then move into real assets big time. What's interesting is that the recent rally in gold was a rally without the Western investors.
Yeah.
The Western investors have been so focused on Bitcoin and Magnificent Seven that they have completely forgotten about gold. And when you look at the ETF gold holdings, actually the gold they hold has gone down during the rally, and that tells you that they have been selling and not buying gold. And I talked to several people who had gold for a few years, and they told me, well, they sold it because it was kind of boring. They sold it at 2000 or whatever, or at 1850 or so. And this is exactly the good thing about what's happening. There is distrust among the Western investors to gold. I think gold will go a lot higher, and silver will probably outperform gold, and other commodities will also run. Copper is one that will run. Of course, if we have a recession, there will be a quick shakeout. There could also be a shakeout in the oil price, maybe down 15% or something like that, easily. But you buy it and you hold it because 2-3 years from now, it will be a lot higher. And that's the next bubble that I see. The bubble will probably peak when the meltdown in the bond market is at its highest.
Yeah, I think there's an awful lot of sense in that. You're talking of this this kind of war between the BRICS and the G7. It's just one of the many wars that we seem to be fighting that you've laid out so well. What did you make of the bill that went through this week to repurpose the frozen Russian assets and propose giving them to the Ukraine as kind of early war reparations within the context of, not from a political standpoint, but within the context of that as a decision feeding into this antipathy between the BRICS and the G7 countries?
Well, first of all, let me say I have a great affinity with the US, and I have no affinity with autocratic systems. So I'm a freedom fighter, and I'm for free markets, for market economics, not planning economics and things like that. But, you know, it's interesting that the Western side is calling on international law whenever it helps them, but they are disregarding international law when they break it all the time. So you have to be careful. You know, our media today is a propaganda media. We are at war, and unfortunately, the media, the mainstream media, is not as diverse and not as critical as it should be. It is not fulfilling its function. It's even worse in Europe than over here. Here you have two parties that are both run by their extreme sides, wings of the party, and the media is catering to them. So you have at least two different sort of viewpoints. But in Europe, this is completely gone, and you have the more critical viewpoints more in social media that has its own dangers because there are some fake news also. It's a jungle out there, and you have to work through the jungle and then combine the dots and come up with the picture that makes the most sense for you. And that's what I'm doing for my subscribers.
Yeah. Well, just another question on this idea of what the governments are going to do in this situation. We've got a question here talking about government financing being heavily reliant upon increased asset prices, and obviously the capital gains taxes and the taxes that come in on the back of that. Does this carry on, or are governments going to be forced into try and gently, which I'm not sure that's possible, deflate asset prices and try to switch that into more fiscal financing?
That's what the Fed tried in 22, gently disinflating, and we have seen where it leads to. Eventually, they have to turn around. And they use gimmicks. They tell you on one side of the mouth, they speak about tight monetary policy to fight inflation. And on the other side of the mouth, they are trying to protect the bond market. The yields do not fulfill the function that is normal in a market process. In a market economy, interest rates are giving signals to the policymakers and to the subjects operating in that economy. We are suppressing all those signals, and therefore there is a lot of confusion because markets cannot give us the signals anymore that they usually gave us. So you go to those markets that are the freest, and even the stock market is, I think there is also some managing of the stock market going on occasionally. And you know, the Fed has never been audited. We do not know what's going on. We do not even know how much gold is there. And that's why many central banks, even friendly to the US, are requesting the transfer of gold back to their country because faith, trust in the government and amongst governments has gone down, and that trend will continue also. So it's a completely different environment than from where we come from in the last 50 years.
Yeah, I think that can't be overstated, this breakdown in trust at all levels of society and between
Yes.
citizens and their governments, and between one government and another. It just can't be understated. Let me just try and cram one more question here. We've talked about a fiscal crisis, and it's something that is bandied around in just about every conversation you have about the situation, trying to figure out a way through it. And Ed's put a question up here that a few people also want me to ask, which is a very simple one. Is there a way that we can avoid this fiscal crisis, or is it inevitable at this point?
Oh, sure there is a way, but it's not politically feasible. You know, you can go and try to restructure everything. You have to change some laws and you have to take some goodies away from some people, and then you have a revolution. And politicians will not get reelected, etc. So it would be possible in theory, but in reality, it's impossible. You have to go to the extreme, and only then you get the change. Once you are deep in the mud, up to your head, you know, then you begin to change, not before. And the people who are able and willing to lead the change will then come in. They are still hiding. They are out there.
Well, I can't say I blame them for hiding. This is not a world where you want to stick your head up, particularly politically. But Felix,
right.
We've got 30 seconds left, so I want to just take that time to thank you personally for all the incredible advice you've given me over the years, and the wisdom you've shared with people, not just through your own work and your writing to your clients, but in venues like this where people from a broader church get a chance to listen to you. You are the very best at what you do. I'm immensely appreciative for everything you do for everybody. And on behalf of the audience today, I'd just like to thank you for doing this session with me. It's been, as usual, just incredibly powerful. Thank you.
Thank you very much for having me at the conference. And thank you, Grant. You are the best interviewer I have seen in the world. Thank you.
Thank you, Felix.
Couldn't agree more. Thank you so much, gentlemen. That was amazing. My hand is cramped. That was the fastest 15 minutes I've ever experienced. Filled a book. Thank you, gentlemen.